What is inflation? Inflation refers to the general increase in price of goods and services over time, leading to a decrease in purchasing power. To measure this, we use the Consumer Price Index or CPI. The CPI tracks the average change over time in the price paid by consumers for a basket of goods and services. It's a crucial indicator of the cost of living and economic health. Let's take a closer look at Malaysia's current inflation situations. As of February 2025, Malaysia's inflation rate is 1.5%. This is relatively low, meaning prices are rising at a slower pace. However, core inflation, which excludes volatile items like fuels and food, was 1.9% in February. According to Bank Negara Malaysia, the inflation rate for the 2025 is expected to stay between 2.5% and 3.5%. The CPI graph helps illustrate these trends over the past few months and show how inflation fluctuates. Furthermore, there are three main types of inflation in Malaysia, which is demand-pull inflation, cost-push inflation, and imported inflation. Now let's look at the type of inflation we are experiencing in Malaysia. First, we have demand-pull inflation. This happens when people are spending more than usual, but business can't keep up with the demand. For example, during major festivals like Chinese New Year, people buy more food, clothes, and gifts. That will push up the price. Next, we have cost-push inflation. This is when the cost to produce or deliver goods goes up, such as fuel price, electricity, or wages. For example, if petrol becomes more expensive, companies raising their price to cover delivery costs. Third type is imported inflation. Malaysia imports a lot of goods like electronic, machinery, and some foods. If the ringgit is weak, we have to pay more in ringgit to import the same item, making them more expensive for local consumers.
Cost of inflation. There are three factors cause of inflation. First, we have demand pull inflation. Second, imported inflation. Third, built-in inflation. Demand pull inflation. It happens when demand of goods and services exceeds supply. For example, during strong economic growth, everyone wants to buy house and cars, but there are not enough to supply, so prices go up. Second, imported inflation occurs when the price of imported goods rise. It happens when due to currency depreciation. For example, when a weaker currency makes foreign goods more expensive compared to their original price. Third, built-in inflation. It happens when the workers demand higher wage to keep up with the rising costs. Then business raise price to cover higher wage expense. This cycle keeps repeating.
So how to measure inflation? The inflation rate measured by the change in the Consumer Price Index (CPI) reflects the average rate of increase in the price of a basket of goods and services. The Consumer Price Index is calculated by the Department of Statistics Malaysia (DOSM). The Department of Statistics Malaysia (DOSM) state that Malaysian inflation remained at 1.7% in January. As the data from Department of Statistics Malaysia state that inflation by the main group from food and beverage is decreased on January 2025, that only stayed 2.5% compared to the 2 December 2024. And the inflation for subgroup of food and beverage in category food away from home is increased to 5.0%, as well as fish and other seafood that stayed 1.0%. In addition, DOSM also state that the inflation by main group for health, transport, education also increased.
Positive effects of inflation are promote wage increases, increase asset value, increase economic activity, and encourage consumer spending. First positive effects of inflation is promote wage increases. As living costs climb, employers often increase wage to help employees manage higher expenses. This enhances worker quality of life and drive higher productivity. By aligning wage growth with rising prices, individuals can preserve their purchasing power and continue affording goods and services amid inflation. Second positive effect of inflation is increased asset value. As prices rise due to inflation, people often turn to investment like stock, real estate, and commodity to protect their money. This growing interest in assets can drive their value up, helping investors preserve their purchasing power. Third positive effects of inflation is increased economic activity. As inflation pushes up demand for products and services, companies grow to fulfill this need, leading to more hiring. This results in job creation, a decreased unemployment, and stimulate economic growth through higher production. The fourth positive effects of inflation is encourage consumer spending. Inflation can encourage consumers to make purchases earlier to avoid future prices increases, driving higher spending on goods such as appliances, electronics, and vehicles. This rise in consumer activity support overall economic growth.
Next, what is the negative effects of inflation? First one is reduced purchasing power. When inflation occurs, the same amount of money is able to purchase fewer goods and services than before. This leads individuals with fixed incomes to experience a lower standards of living. The second effect is raises interest rates. Inflation leads central bank to raise interest rates in an effort to control rising prices. Higher interest rates make borrowing more expensive for consumers and businesses, resulting in reduced spending and investment. Next, increase economic inequality. Inflation increases economic inequality as lower income groups are more affected than the wealthy. While the rich can protect their wealth by investing in assets like property or stocks, the poor must spend most of their incomes on daily necessities, which become more expensive. This widens the gap between the rich and the poor. The last one is reduced exports. Inflation can lead to reduced exports as the prices of local goods increase, making them more expensive compared to foreign products. As a result, consumers from other countries may choose to stop purchasing from us due to the higher cost of our goods. This decline in export sales can negatively affect the country's economy by reducing income from international trade.
Monetary policies is an economic policy that manages the size and growth rate of the money supply in an economy. It is a powerful mechanism for regulating macroeconomic variables like stability, inflation, and unemployment. These policies are implemented through different tools, including adjusting interest rates, purchasing or selling government securities, and changing the amount of cash circulating in the economy. The central bank or a similar regulatory organization of a nation are responsible for formulating these policies. Economic statistics such as gross domestic product, the rate of inflation, and industry and sector-specific growth rate influence monetary policy. Let's discuss the type of monetary policy. Monetary policy are seen as either expansionary or contractionary depending on the level of growth or stagnation within the economy. One, expansion monetary policy. This policy is applied when the economy is sluggish or experiencing a recession. By increasing the money supply and reducing interest rates, central bank make borrowing cheaper, encouraging consumer and business to spend and invest more. This can help boost economic activity and reducing unemployment. 2. Contractionary monetary policy used to combat high inflation involve reducing the money supply and increasing interest rate. This make borrowing more expensive, discouraging extensive investment by slowing down economic activity. The central bank can bring inflation back to manageable levels. What are the main goals of monetary policy? Number 1. Inflation. Monetary policies can target inflation levels. A low level of inflation is considered too healthy for the economy. If inflation is high, a contractionary policy can be used to temper inflation and reduce the level of money circulating in the economy. 2. Unemployment. Monetary policy can influence the level of unemployment in the economy. For example, an expansionary monetary policies generally decrease unemployment because the higher money supply stimulates business activity that lead to the expansion of the job market. 3. Currency exchange rates. Using it fiscal authority. A central bank can regulate the exchange rates between domestic and foreign securities. For example, the central bank may increase the money supply by issuing
currency. In such a case, the domestic currency becomes a cheaper relative to its foreign.
What is fiscal policy? Fiscal policy is a deliberate action of government to influence the changing level of government expenditure and government taxations. How the fiscal policy affect inflation? First, increase in taxes. The government tends to implement regressive tax structure or increase its indirect taxes on goods and services to reduce the impossible income of individuals. 2. Decrease in government spending. Government should postpone some development project and reduce its operational expenses in time of inflation.
Controlling inflation, supply-side policies. First, investment in infrastructure. Upgrading transport, logistics, and digital infrastructure to reduce business costs and improve supply chain efficiency. For example, expansion of ports, highways like Pan-Borneo Highway, or digital infrastructure to reduce delivery times and costs. Second, enhancing labor productivity. Training and upskilling programs to boost workforce productivity. TVET, technical and vocational education and training programs supported by the government can reduce skill shortages. Third, tax incentives for producers. Offering tax breaks or incentives to business in strategic sectors like manufacturing or agriculture to encourage investment and reduce unit costs. This can stabilize or lower prices in the long term. Fourth, subsidies and support for key inputs. Temporary subsidies for essential inputs, example fuel, fertilizer, electricity, to lower production costs. For example, fuel subsidies help control transport and logistics costs.